Today, I'd like to discuss that now that the markets have a relatively calm day, what are the central banks doing? Remember, if you follow me, I look to see what the stress is and then how do the banks react to the stress. To me, the reaction of our central banks, not our banks, of our central banks, tell us far more than what we actually just went through in the market, because their reaction tells us on how serious they think it is. So last night, the BOJ says, guess what? We're not going to raise our interest rates for the near term. And you can see here in the second paragraph that the Bank of Japan's deputy governor said the sharp volatility in domestic and overseas financial markets, and said it's necessary to maintain current levels of monetary easing for the time being. This is a pretty big thing, because when you think about it, with your currency, and when your currency is under attack, you have two things that you can do. You can raise or lower your interest rates, or you can let your currency float free, okay? So if you take one of those legs away, which the BOJ just did, they're basically saying, we're going to let the yen go where it's going to go. So I think they're hoping that the move in the yen has been so big that it's kind of at a level where they do not have to use the interest rates. But they obviously feel that it's better to let the yen kind of find a new level, wherever that's going to be, than for them to raise the interest rates again. The problem with this is they're literally saying to the investment world, risk on again, you can put on your Japanese yen trade here at 25 basis points if you want, versus when it was at 0. Will that happen or not? I don't know. I don't have their algorithms, their trading, their leverage, all this other stuff. But basically, this is what the BOJ has now said to the markets. Now, the Federal Reserve is facing a different situation. This is the Bloomberg U.S. Government Treasury Liquidity Index, and as you can see, it's highly stressed, which I know doesn't make a lot of sense to me either. We have 35 trillion in debt. We're issuing or reissuing a record 9 trillion this year. And even in this article, someone said, is this because of the ATI, where the government's only issuing about 80% of T-bills? You can see I have them pinned up there. You can go through that yourself. I don't know why this is, but it actually is. And as you can see, we are highly, highly stressed. And so yesterday afternoon, out comes the Treasury and says, hey, over the next 3 months, we're going to buy $50 billion worth of U.S. government bonds. Here they are. Here's the dates we're going to buy them at. We'll give you the QSEP numbers on those days at 11 o'clock. You go, okay, so what's going on here? I mean, we have QT. QT was $94 billion a month. This is letting things just come due. Then we made it $50 billion. Now it's $25 billion. Are they going to stop QT at the $25 billion a month? They didn't make any statement on that whatsoever, okay? As for a cut, the Fed did not do the emergency cut yesterday, I think, thankfully, okay? I can't believe that Bubble TV was calling for 50 this month, and then 50 for 2 more months, or 150, and someone was calling for 75 basis points this month and next month. Frankly, I think that's insane. So I think the Fed and I are going to be watching the 10-year bond. As you can see it, I think it hit like 378 or whatever, or 370. Now it's up to 394. I think you're going to, if we're not going into a recession, I think you're going to see this one continue to move up in yield and down in price. If you remember on Monday, I said be very careful of the bonds here when we were at 370. I felt that it was a misread by the markets and that the bond prices were going to drop and the interest rates are going to go back up. That's what I think is going to happen. The last thing is, as I said, we're going to be watching for if there's a blow up in the system, because the blow up is the stress, and then we see what the central bank's reaction is. It's the reaction that tells us where we're at. So we're knowing now the hedge funds that did well. You want to read this article. This guy was up 4% for the month. We know this because he sent it out to his clients saying, I'm up 4% this month. If you were down 4% or 10 or 20% this month, I can assure you, you did not send out a letter. We don't know about it yet. So we still don't know where the blowups may be or may not be. But with the markets down $6.4 trillion, I think that there's somebody somewhere out there that has trouble. So what does this all mean to us? Well, since the great financial crisis, it's always been buy the dips. I get it. If you didn't, you didn't do well. If you did, you did very well. But I would also say that we are now in a position where the currencies are kind of going a little crazy, and we have to figure this out. And even though the yen carry trade is a big trade, it still hasn't worked its way through. We still don't know who is blown up. So I would say caution here. And also on one of the comments, when you get in a situation like Friday and Monday, everything goes down. If you notice, I think there was one thing up. That was the government 10-year bond, right? Everything else was down. Gold, silver, oil, everything, right? Because when you're in a yen carry trade and you're getting out of that, you're basically liquidating your investments to go back and take care of your debt in Japan. So that means you liquidate your best stuff. You could be up on gold, you could be up on whatever, right? That's what they sell. So when you end up in a situation with the yen carry trade, where people are saying we have to fix our base leverage, they sell whatever is sellable, right? Especially, hopefully they can take a profit. They'll try to keep the losses to see if they can make them up later. So that's where we're kind of at. And so until we get a little bit more clearer path, I would say, be cautious. So what do you think? Like and follow, and certainly comment.